Now, the big challenge for all property investors at the moment is actually just borrowing enough money to continue to go and invest. So no one has an issue at the moment with equity. Property prices have been consistently improving for the last 5 years. Everyone's got equity. No one has capacity. Now, a lot of times it just gets dumbed down to income and liabilities and the bank's buffers, and that's all you need to know. But there's a few other nuances to this that I think if most property investors knew, then they could make better decisions and keep their property portfolio moving along. And that's what we're going to unpack today. So let's get stuck into it. So here's something to think about and keep in your mind. Banks aren't using your true numbers to create their loan applications. You know this. You've been told that they're going to put buffers on some of your debts. Like some lenders will even buffer your car loan repayments. That's mental and makes no sense. Also, some lenders, although you might have really super tight living expenses and you buy your own groceries, you cook your own meals, and you manage to keep your costs right down, they will still put or living their own table of living expenses in your loan applications, which is hurting what you can do. Banks also are synonymous for shading back your income. They will shade back your rental income, they will shade back your overtime, they will shade back your allowances to come up with their own set of figures. All of these things are working against you in your loan applications. And why? Well, banks always go with the worst case scenario for your set of circumstances. They're being responsible in the eyes of APRA and ASIC and lending governing bodies in order to make sure that they're protecting themselves. But what it's doing is it's holding you back from doing what you want to do, and that's get on and buy more property. So today we're going to unpack the 7 of these that are causing you the most amount of damage and have a look at some ways to maybe work around or take these into consideration with future purchases. So the number 1 on the list is HEX. Most people don't even think that this is a debt. They certainly don't pay it on a monthly basis, and it's usually taken out of your tax return at the end of the year. But what a lender is doing is they are going to put your income into the HEX payment chart, work out what your annual is, divide it by 12, and then put that in your servicing calculator like it's an ongoing debt. The problem with them doing this is that your HEX payments for last year were based on your last year's income. They're basing it on this year's income, whatever's written on your pay slip when they do their calculations, because it's a percentage of your income. So if you've waited for a pay rise before you go and put in your new loan application, well, great news, the bank has already taken that pay rise, worked out the HEX that will be payable on your next year's income, and then put that in their servicing calculations. Now this could be costing you up to $100,000 in available borrowings. Number 2 are the credit card limits that you don't even use. I think somewhere along the line having a $20,000 credit card or having an Amex Black card or something like that was a sign of prestige. Now it's become a sign of stupidity. We know that what they're going to do is they're going to take the limit of your cards, times that by 4%, and then put that in your living expenses or in your servicing calculation as your ongoing commitment. So if you've got a stack of credit cards, because it's an image thing, then get rid of them. Chop them up, cancel them, burn them. We had a client the other day with $150,000 in credit cards that he wasn't using that was costing him hundreds of thousands of dollars in debt servicing capabilities. So they are a killer. They're a killer to a lot of loan applications. If you don't need them, get rid of them. Try to have credit cards with no more than a $5,000 limit. Number 3, any kind of payday lender, Zip Pay, Nimble Loans, all of that kind of thing. This stuff is the modern form of bankruptcy. If you are going to a lender saying, I can't manage my monthly living expenses to a point where I can meet all of my commitments and I have to rely on these facilities, or I have had to rely on these facilities, it's not painting a good picture. Whenever you don't paint that good picture, guess what lenders do? They tighten up on everything in a loan application, including servicing and buffers and assume living expenses to a point where it breaks the loan application or gives you a much worse outcome. Don't have these facilities. There is no need to have them. You're much better off just to have a small credit card if you do need some cash flow buffer at some point in time. But all of these short-term money options, they need to go. The next one is childcare costs. We know how expensive childcare is, and we know how expensive life is when we've got little people in our house under the age of 5 that aren't yet attending school. Now, it is important to try and keep your childcare costs as low as possible. Use family wherever you can, but understand that some lenders, when they see a 2 and a 3-year-old on your loan application, they will be immediately wanting to know where those childcare costs are in your loan application and how much you are paying. And if it doesn't look like you have declared enough for your childcare costs in your loan application, they will be ratcheting them up to be in line with current market expectations of childcare. So if you do have little people in your house, make sure that your childcare costs are fair and reasonable. We're not overspending. See if we can utilize family members wherever possible to bring those costs down, because they do really hamper your ability to borrow. The next one is car loans and leases. And don't even start me on salary package leases. They are the worst of all. For some stupid reasons, Australians love a brand new car. But guess what? Banks hate brand new cars, and they certainly hate people that salary package in order to purchase them. If you can't afford your new car with cash, don't buy it. So there's an old saying that is, you should drive the cheapest car that your ego can afford. Now, if you go and get yourself a $50,000 car loan with repayments of $1,000 a month, you're immediately knocking, say, $100,000 to $170,000 off your ability to borrow for residential property. And if you've got one of those salary packages that has your fuel and your insurance and everything else built into it, great news. One of those cars at about $80,000 is the equivalent of about $250,000 worth of borrowings. It's mental. If you are saying, I want to get on and be serious about being a property investor, then you don't have a salary package car. And that's just the end of it. The next one is investment property holding costs. Now, this is one where the devil's in the detail. Now, when you're a starting out investor, a bank will just take your rental income statements. They will then take what the gross rent is, and they'll just take a percentage of that gross rent. No problems at all if you're buying your first or second property. It's all pretty easy. But once you become a more experienced investor, and we're getting out to properties 4, 5, 6, 7 potentially, then banks will have a different set of policies that they employ. And most of those policies entail either going to the annual renting statement for that property to obtain the outgoings for that property, or your personal tax returns or the trust tax returns to evidence what the outgoings on that property are. So in these instances, when we've got things like strata, other insurances, when we've got things like miscellaneous items of expense, when we've got a property that had previously big breaks in its occupancy in the previous year, that kind of thing is then all going to start to show on your tax returns, and therefore it might be something that we're showing to a lender later on down the track. And also, it's really important to remember that, as per our previous video when we talked about short-term rental, it gets even worse in terms of the shading and the adding in of costs when it comes to short-term rental properties, because they might be looking at 12 months worth of annual receipts or ledgers in order to work out what the outgoings are for that property. So if you want to keep on the front foot with this, always remember, have your tax returns reflect the true expenses of your property. Always trying to minimize your expenses wherever possible, because you never know who's going to want to look at those tax returns later on down the track. Number 7, and this is one I'm guilty of and many families are, private school fees. Now, it might be a little bit of a luxury to send your children to a private school or a Catholic school where you feel that they might get a slightly better education. Once again, the key term is you feel that they might get a slightly better education, but lenders actually don't like private school fees. They'll dig through your bank statements to try and find them, and they'll make sure that you're doing everything to declare your full amount of private school fees. They not only know that you've got your private school fees that you may pay every quarter, but they also are looking for extracurricular activities. They're looking for after school care costs. They're looking for sporting costs. They're looking for camps and other things that the children do whilst they're at school that might be one-off ad hoc expenses. But they will pull them together and call them ongoing child education. And this can really affect your loan application. You've got to remember, your kids are only at school for 6 years. The most expensive section of private schooling is obviously the high school years, 7 through 12, but the bank is factoring in these costs in your ongoing living expenses on a 30-year loan. So they're really kind of overstepping the mark, but they will do it, and you just need to be vigilant of it. Maybe do your borrowings before they start year 7, or do your borrowings before they start year 11. Put your borrowings into a sequence where you can work around your school costs. And I've got one more for you as a bonus. These are tax bills and ATO debts. Now, if you have one of these lurking on your statement of position, it does two things. Number one, they're going to put it in as an ongoing commitment. The ATO is not currently mucking around when it comes to recouping money that's owed to them. So therefore, your payments on ATO debts are most likely on a very short term, and your payments are through the roof, and that does hamper any further borrowings. The second thing that happens when there's ATO debts that crop up in loan applications is the bank immediately puts on its spider senses and gets very touchy about your loan application. They want to know how the tax debt was accrued in the first place. Obviously, there was some kind of cash flow challenges between incomes and expenses, and you've chosen to use the ATO as a bank, and they don't like that. So they will then tighten up on your loan application. Best advice here is don't try to borrow when you've got ATO debts floating around. If you need to, go to the appropriate lender. If possible, tidy up your ATO debts before making any loan applications. Okay, so here's the quick list on how to fix everything. Number one, turn off your credit card limits that you don't use. Number two, get rid of all your zip pay, afterpay, and any short-term money, and never use it ever again for the rest of your life. Pay off your car loans, car leases, get those things closed down. Maybe sell the expensive car that you don't need and start driving yourself around in something that's a little bit cheaper. The next one is reassess your childcare plans before making loan applications. See if we can grab a few more days with grandparents or family members in order to lighten up on our childcare costs. Same goes with private schooling. If you're thinking about borrowing in the next 12 months and you've got someone who's just about to complete year 12, push your borrowings out for a little bit. Once you've taken all of these things into consideration, be vigilant with your lender. How do the different lenders that you're considering look at all of these things? And there's probably one that is more advantageous for your personal set of circumstances than others. Work with a broker to find which lender is most appropriate for you. It might not be the one with the best interest rate. It might not be the one with the most amount of branches. It might not be the one that you're currently working with. It might be someone completely different, but a good broker should be able to give you all these options. The last thing is, don't think that as soon as you engage with a broker that you need to put in a loan application. It's all about looking at your current set of circumstances, working out what you can lighten up on, making those changes, and having a look at the various outcomes. What does it look like if you wait until the car loan's closed? What does it look like if you wait until your youngest child's finished year 12? What does it look like if you close down these credit cards? And then make decisions based on the things that you can adjust and the amount that you can borrow with each adjustment. Most brokers are happy to do this and will workshop a loan application with you over many months before they actually submit. So if you found today's information super helpful, by all means, like, subscribe, and share this with another fellow investor. If you're not sure or you want to work through those math and numbers, please reach out to myself or my team. There's a link below. You can book straight into our calendar and we can run through what your situation looks like at the moment and what adjustments you can make to really boost up your borrowing capabilities.